From R.D. Smothers Wealth Management, this is The Retirement.
When you retire, if you want an exciting life, you need a boring investment strategy.
Matters.
If you enter into retirement without a plan for income, you're not retired, you're simply unemployed.
Podcast.
Hey, this is your host, Dale Smothers, and you're listening to the Retirement Matters Podcast. My hope is that you will find the information you need in every single show on how to do one of the three things: either saving more money more efficiently, planning better for your future where you can live in retirement worry-free, or my favorite, how you can live a happy and fulfilled life in this life you have been given. We know that your time is valuable and we appreciate you spending it listening to this episode of the Retirement Matters Podcast. On this episode of the Retirement Matters Podcast, we come to you with some information about how the price of oil may affect a retirement plan and how it's entirely possible to build a plan that will allow you to walk away from the fear and worry and enjoy the journey of retirement along the way, all the ups and downs and twists and turns included. We also take a deeper dive into Medicare and why it's important for Medicare planning to be done not in a small scope, but instead in a holistic, comprehensive part of your overall retirement plan. Now, we hope you enjoy this episode. We hope that you're enjoying this show. The Retirement Matters show is built to help you navigate through retirement. If you know anybody who would benefit from listening to the show, we would appreciate you sharing this either on your own social media or maybe just shooting it over to them via text and letting them find the podcast as well. And of course, we would love for you to leave an honest review and rating on the podcast streaming service of your choice. So I hope you enjoy this episode of the Retirement Matters Podcast. Good morning to you. I hope you're doing well and you're ready to start discussing all things retirement matters. I've got a lot to discuss with you on this morning's show, and I can't wait to get into it all. We're going to discuss the oil trade and how the price of oil is likely to affect your retirement account and what you need to do to prepare for it. We're also going to try to get into some things that you may need to know about Medicare and why Medicare is important for you to navigate correctly as you enter into retirement, some things that you may not even be aware of and some things that you may think you know that are common misconceptions. We're going to discuss all of this in today's show, but before we get into any of that, let's go to our Pause for Positivity in this week. The Pause for Positivity is a throwback to something we did probably 2 years ago about this Purdue University study that was ran to figure out how many licks it takes to get to the center of a Tootsie Roll Pop. Now, this question comes from an ad campaign years ago, back in the early 80s, I believe it was, where the Tootsie Roll Pop was brought by a young boy, and it was a cartoon ad. The young boy brought it to an owl and asked the owl, the wise old owl, how many licks does it take to get to the center of the Tootsie Roll Pop? It sounds something like this. You may remember this from when you were a child.
Mr. Owl, how many licks does it take to get to the Tootsie Roll center of a Tootsie Pop?
A good question. Let's find out. 1, 2, 3.
If there's anything I can't stand, it's a smart owl.
How many licks does it take to get to the Tootsie Roll center of a Tootsie Pop? The world may never know.
All right, so that is the ad, and then the question itself is really one that Purdue University set out to answer, and effectively they did answer. They answered this question with 2,500 licks for the average size Tootsie Roll Pop. Now, this is something, if this sounds familiar, this is something we covered about 2 years ago, and a client actually brought it back up to me in office just a few days ago, and it made me think again about where I'm at in my life, and it is to be where your feet are. Trying to be where my feet are is the primary objective for me in my own personal life. To spend time with my family when I'm with my family, and work hard when I'm working, but don't take work home. And try my best to be there with them to create those memories and enjoy the journey of life. And this question that was asked, one of my clients said she remembered our radio show where we discussed the Tootsie Pop, and it made me remember the story again. And I thought I'd bring it up today because It's a cute illustration of really asking yourself, why does it matter to know the answer of how many licks does it take to get to the center of the Tootsie Pop? Why does that really matter? It doesn't. The purpose of buying a Tootsie Roll Pop is not for a scientific experiment. It's not to try and lick the Tootsie Roll Pop and count the licks. It's just to enjoy the Tootsie Pop, to enjoy the candy. And if we're not careful, as crazy as this ad is, as funny as it is, as foolish as it may be, if we're not careful, we'll go through life with the same mentality, unable to enjoy life itself because we don't have all the answers that we seek, unable to enjoy life itself because something just isn't making sense to us in a certain situation we're going through, or maybe because we don't have the answers to all the questions, we're unable to move at all. We are paralyzed in our current situation because the answers evade us. When in reality, if you know the next step, you don't have to see your entire path through the woods. Just take the next step. If you know where the next step is, take that next step. You will eventually gain perspective that allows you to navigate through your situation. And so this center of the Tootsie Pop experiment that was produced by Purdue University, essentially taking a machine that precisely licked, it was a licking machine, believe it or not, that licked this Tootsie Pop until it got to the center and did it over and over and over again and came up with an average of around 2,500 licks. It was a waste of time because no one cares. It was all a joke, and clearly, I don't care what Purdue University does with their time. But if we're not careful, we'll waste our own time forgetting to enjoy life, instead seeking to understand it before we live it. And the funny thing about life is it's really difficult to understand it until you live it. So while living it, enjoy it. Take in the memories. Take in those moments and make memories. Because unfortunately, life is best understood after you've made it through. So while making it through, enjoy it. This is the Pause for Positivity, and I'm going to challenge you, as I've challenged myself for the last several months, to just be where your feet are. Don't live in tomorrow. Don't worry about yesterday. Be in the present. And it's called the present because it's a gift from God. So let's cherish it together. That's our Pause for Positivity this week. Hope that you've enjoyed that. The small little story about the Tootsie Pop is just a cute illustration to really get to the point. And we're going to take a quick break here. We're going to reset. We're going to come back with some information about what's going on in the markets today and what's going on in the global oil trade and war in the Middle East and how it could very easily affect your retirement account. A couple ways that you can just alleviate the stress altogether and have a retirement account that allows you to, just like you would the Tootsie Pop, forget about trying to find all the answers and just enjoy the sweetness of retirement. We're coming right back with more Retirement Matters after this.
Thank you for listening to Retirement Matters, presented by R.D. Smothers Wealth Management. We help folks just like you retire the way they desire and live happy in retirement. If you'd like to speak with us, maybe even just ask some questions, give us a call at 270-600-PLAN. That's 270-600-PLAN. And if you enjoy the information in this show and would like to hear more, you can access previous shows by searching for the Retirement Matters Podcast on the podcast platform of your choice. That's the Retirement Matters Podcast, available to you 24/7 wherever you listen to podcasts. We also produce a weekly newsletter. Receive it free to your email inbox by signing up online at rdswealth.com. That's rdswealth.com to sign up for our free weekly newsletter. Our phone number once again, 270-600-PLAN, and online at rdswealth.com. Be sure to sign up for our free weekly newsletter.
All right, welcome back to the show. War has broke out in the Middle East, and ideally, this war ends quickly. However, if it doesn't, what does that do for your retirement account? I think it's important to understand that since 2022, we have seen the price of oil come down substantially, getting to around $60 or $70 per barrel. Now, in the last week, we have seen the price of oil skyrocket above $100 per barrel. And what we've seen since 2022 in the stock market has been nothing but up. It's been a very, very good few years in the market. A lot of this has to do with artificial intelligence and the spending and build out of artificial intelligence, people getting in front of the next frontier, or what may be very easily called the next industrial revolution. And while technology has certainly cooled over the last few months, a lot of the volatility that we are feeling right now is all due to oil prices. So my desire is to help you maybe alleviate some fear and worry, and maybe even discuss some things that you can be doing now in retirement planning to offset any kind of potential losses in your portfolio. Now, many people right now are concerned about what's going on in the stock market, but never really taken a step back to look at where we are. And when you look at the overall stock market, the S&P 500, we're just a few percentage points off of all-time highs. We've pulled back, but we've not seen a tremendous amount of sell-off. It's just been a lot of up and down, a lot of back and forth. We'll have a good day, then we'll have a bad day. And the bad days tend to be a little worse than the good. And for that reason, we are a few percentage points off of all-time highs. But we're nowhere close to what we may deem to be a normal correction. If you're familiar with the stock market, you've seen 10% corrections in just about every year in the last 70 years. 10% corrections happen very, very frequently. The 10% correction is what we may call even a financial winter. It comes as regularly as winter months. Snow in winter is normal. We don't wake up seeing it snow outside, and especially in this Kentucky and Tennessee region. If it snows, it doesn't make us freak out. And we don't automatically run out and sell all of our swimming trunks just because it's snowing outside. And this is the same thing we should consider in the stock market. The 10% correction is normal. Doesn't mean we go and sell all of the good stocks that we own in that 10% dip. But the thing is, we're nowhere close to a 10% correction, and the news media would have you to believe that the market is falling off of a cliff. Now, depending on where you're invested, you may have felt more than a 10% swing in your portfolio, but it's likely that if you're close to retirement, you're working with any kind of an advisor at all, you have not felt anywhere close to 10% swings in your overall portfolio. I know at RDS Wealth, we do our best to safeguard against downside movement. And this is a way that we build portfolios with options and what we call risk on and risk off investments. And these risk off pieces of money haven't moved at all in the last few months. Since October, the market has kind of traded either sideways or down. But this risk off piece of money has been steady. And it's sitting there waiting that if the market were to take a upward trend, that money makes money. But if it takes a fall to the downside, we have money that has stayed and behaved just like cash that we can deploy then into a cheaper market. This strategy is one that you should be employing in your own retirement plan. Now, you may ask, how can I do that, Dale? How can I have this risk on and risk off approach to retirement? Now, keep in mind, we have trademarked the risk on, risk off portfolio, so I can't necessarily give you exactly what I would do for you. If you were a client of RDS Wealth, our advisors would be able to set you up with a risk on, risk off portfolio, but I will give you some insight on how we build the portfolio and some things that you may be able to deploy in your own. Looking at strategies like structured notes, CDs, bonds, even money market accounts, looking at options strategies where we build collars around the S&P 500. This is one of the ways that we help structure the risk-off piece of our portfolio. If structured properly and on the right types of platforms, it can provide you ultimate downside protection against market movement, but still give you upside participation if the market goes higher. So I'm very optimistic about where the market could be 5 years from now. 5 days from now, it's hard for me to tell you exactly where this market may be. And what we know is that if we see good buying opportunities due to the price of oil, let's say, we want to be able to jump on those opportunities and purchase stocks that are on sale. This is one of the things that we do for our clients. Structuring this risk-on, risk-off portfolio in a way to where we can buy good names when they go on sale and still generate income to the clients who need it in the years that the market doesn't cooperate without selling securities or stocks at a loss. So what may happen if the price of oil continues to rise and stays above $100 a barrel for a very long period of time? What happens to your portfolio? Maybe you've never seen what takes place if energy cost goes up like it did in 2022 or like it did in 2008, 2009. Maybe you've never seen what a 2000 type scenario happens to do to your portfolio. We can help you understand that. We hook you up to a retirement portfolio stress test where we can take your exact portfolio, run a stress test analysis on that portfolio, and show you what it would look like if the market were down 20%, 30%, 40% for different reasons. Keep in mind, a 10% correction is normal, but can your portfolio weather the 10% correction? What happens if a 10% correction takes place? What does your portfolio do? What do your stocks do? What does your 401k do? What if your retirement plan itself can't afford to lose 10%? Then how do you structure your account? These are the questions that we help seek to answer with you as we sit down with you to discuss building your own retirement atlas. The retirement atlas is your blueprint, your plan, your map to get you where you want to be in retirement. We would love an opportunity to help you build one specifically tailor-made to you. This 5-map system maps for income, investments, taxes, healthcare, and legacy. These 5 maps get you from where you are to where you want to be in your retirement journey. And along the way, we partner with you to help make sure that you take the right turns. And if twists and turns come out of nowhere, how to navigate through those most efficiently. So for most of our clients, we're not as concerned about this oil spike. Our portfolios are built to weather this type of storm. But are you concerned? That's the question. If you're concerned, we need to talk. And if you're concerned and you would like to talk, it's as simple as picking up the phone and giving us a call. 270-600-PLAN or navigate to our website, rdswealth.com. And we can sit down to discuss your retirement plan today. I am very confident that an advisor on our team can bring some clarity, bring some peace, and bring some comfort to you and your situation. And together, we can start to turn off the noise of the financial news and begin to work on enjoying this journey towards your retirement destination, the retirement you've always imagined. We like to say we help you retire the way you desire here at RDS Wealth and helping you live happy every step of the way. All right, we're going to take a quick break. And when we come back, we are going to jump into some misnomers about Medicare, some things you must make sure you're aware of as you get ready to plan for your own Medicare selections and ways that we can help if you are in the process of looking for Medicare solutions. Don't go anywhere. We're coming back with more Retirement Matters right after this.
You're listening to the Retirement Matters Show with Dale Smothers. Dale is the founder and president of R.D. Smothers Wealth Management. We specialize in building retirement plans that allow you to walk away from the worry of running out of money. If you'd like to chat with a member of our team, you can do so absolutely free by calling 270-600-PLAN. That's 270-600-PLAN. Visit us online at rdswealth.com and be sure to sign up for our free weekly newsletter.
All right, welcome back to the show. Let's get into a very important topic that a lot of times financial advisors fail to discuss with their clients called Medicare. You would not believe the number of times that we have talked to people who are working with advisors now, and their advisors have never discussed Medicare with them as they approach the age of 65. Now, you can't fault the advisor. It's because they're a growth advisor. It's nothing against the advisor or the company that advisor works for, but it is very likely that advisor is just simply not equipped to help this client with the phase of life they are in. They are likely a growth advisor working with a client who is in income phase, or at least at the very least preparing for income phase. And we talk to a lot of people as they begin to transition from growth phase to income phase because they realize they need someone in their corner in this phase of life. There is a big difference in growing your money and actually taking income from your money. There is a big difference in that phase of life. And these are decisions you must face. And if you're not careful, you'll end up facing them alone, or you'll be looking for different people to give you advice on all fronts. When should I take Social Security? Well, maybe you may even try going to the Social Security office and hoping they can give you some insight, but you'll quickly realize that's not the case. So you turn to Google. And when you turn to Google, it says take it as early as you can, or maybe it says take it at age 70. But has anyone ever sat down to see why it would be important for you to take it at a certain age? Have we ran a break-even analysis? Have you looked at your cash flow statement to see what's the most efficient way to take Social Security? If the answer is no, that's what we do. That's everything that we do for our clients before they take that step. This is why it's important for you to work with an income advisor. An income phase advisor is going to be well-versed in Social Security. An income phase advisor is going to know the ins and outs of Social Security and when you should take it. An income phase advisor is going to be able to help navigate the tax complexities of why you should be doing Roth conversions or why you shouldn't. Holding the right amounts of taxes from your distributions, helping you understand if tax loss harvesting is right for you, helping you understand inside of your tax picture what your beneficiaries will need to pay for taxes, and are there ways to help eliminate or at the very least lower that tax bill for your beneficiary. A good income advisor is going to help you structure an account in their investments to generate the amount of income you need and give you a sense of satisfaction that you can have confidence and freedom to live the way you desire no matter what the market is doing. That's what we do here at RDS Wealth. We structure your retirement accounts, your 401ks, your IRAs in a way that they generate the income you need when it comes time to turn on that income. You may think, well, I don't really need income. Well, now you've got an even bigger tax problem because your beneficiaries are going to receive a substantial amount of taxes, and we've got to make sure we mitigate that for you and for generations to come. Now, if you're over the age of 59 and a half and you've never sat down with the income phase advisor, you may have never heard of any of these things. And if you're close to 65 and you've never had a discussion around Medicare with your advisor, it is almost certain at this point that you are working with a growth advisor rather than an income phase advisor. And it's very likely that you need to consider looking for an income phase advisor. Medicare is extremely important. Doing it right can help save you money. Doing it incorrectly can not only cost you money, but you will know that it cost you money when you get letters in the mail that surprise you with these extra taxes. So in your health care plan, in your Medicare plan, you need to make sure that you are not only selecting the right plan, because as you're about to find out, plans will differ in price and not offer any kind of difference in coverage. You also need to make sure that you are not making too much income in current years or future years that cause you to enter into something we call IRMA. Because unlike buying the wrong plan where you may spend an extra $20, $30, or even $50 extra per month unnecessarily, you may not realize that you're spending that extra $50 a month. You may not have any idea. You may never know. And even though you could have done it more efficiently, it doesn't upset you, so you go on living life just fine. But when IRMA comes knocking at your door and you have to pay extra on Medicare, Medicare Part B in particular, and Medicare Part D, If that happens to you, you know that you're paying more and you know why you're paying more and you wish 100 times over you could have planned better. This is exactly where RDS Wealth comes in, focusing on helping you plan better. Now, I've taken a little bit more time on that section than I had hoped, and I'm looking at my time. I've got just a few more minutes. I need to take a quick break here. And when we come back, I'm going to dive into some specifics of Medicare, why you need to be focusing on these specifics, and how it could impact your overall retirement plan. Don't go anywhere. We're coming right back in 30 seconds with more Retirement Matters right after this.
Thank you for listening to Retirement Matters, presented by R.D. Smothers Wealth Management. If you'd like to speak with us, give us a call at 270-600-PLAN. And if you enjoy the information in this show and would like to hear more, you can access previous shows by searching for the Retirement Matters podcast on the podcast platform of your choice. We also produce a weekly newsletter. Receive it free to your email inbox by signing up online at rdswealth.com.
All right, let's jump right back into our Medicare discussion. And I want to discuss this holistic healthcare planning approach for retirement. And it's so much more than just picking a Medicare plan itself. There's A, B, D. Should you take C? Should you have a supplement? We call this the Medicare alphabet soup because when you dive into the supplement, now you got even more letters. And again, it's so much more than just picking what plan you need. Let's discuss Medicare Part A and B. Medicare Part A is for the hospital. Medicare Part B pays for doctor's visits. Most people get Medicare Part A completely free. Most people pay a premium for Medicare Part B. This year, Medicare Part B is going to run you about $202 per month. Most people will take that premium out of their Social Security. But if you haven't started Social Security just yet, you can write a check or have it deducted from your bank account. Medicare at $202 a month doesn't sound too bad for the type of coverage you get. But if you've not done the right amount of planning and for some reason you slip into IRMA, your Medicare could get to as high as $700 per month. This is Medicare Part B. This has nothing to do with your supplement. Had nothing to do with your Part D, which is prescriptions. $700 a month for the same coverage that everyone else is paying $200 per month for. And here's the kicker. It would not only be that for you, it will also be reflected on your spouse if you're married and filing jointly, which means your premium would go from $200 a piece to $700 a piece, which is a $500 increase or a $1,000 increase across the family. This is huge, and it could definitely jeopardize whether or not retirement is affordable for you. So we've got to know what this is going to look like inside of our retirement plan. Now, what you may be asking, well, what mistakes could I make to make this happen? And I'll tell you a few of the common ones we see. We see a sale of land at the wrong time, a sale of a house or farm at the wrong time. We see a unstructured type of sale of maybe a business or an unstructured sale of certain securities, bonds, CDs. We see people set money in CDs that generate tax that they didn't realize was kicking them into a higher tax bracket and potentially into IRMA. There are alternatives to CDs that benefit clients like this. And we even see people fail to take distributions from IRAs until they're forced to do so, and at which point they are kicked into a higher tax bracket, and as a result, IRMA on their Medicare. Don't allow this to be you. Is it going to impact you? We need to talk to figure that out. Because with a true cash flow analysis, working with an income advisor, you can avoid these common mistakes. We would love an opportunity to help you do this and make sure that your retirement plan is everything that you've ever imagined it would be. All right, we have reached the end of our time together this week. It has flown by. I want to give you one more small tidbit, and that is about the Medicare supplement plan. We help the clients of RDS Wealth establish their Medicare plan. A, B, D. If you need C, we'll help you with that. And then supplement plans. And one of the things that we found, and you should know this, is that supplement plans often will have a big difference in pricing, but their plan protection and coverage is the same. So be careful of that. Too many people are overpaying for supplements without realizing they could get the same coverage for cheaper. We can help you find those better rates and, of course, build it into your entire retirement plan in the process. That's what we're here to do. We would love an opportunity to do it with you. 270-600-PLAN. That's how you get in touch with our team. And, of course, you can navigate to our website, rdswealth.com, set up a time to talk today. Now, until we talk again, whether it's right here on this same show or it's in person in one of our offices, you've got to remember these three things. Always save money, plan well, and live happy in retirement. God bless.
Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. R.D. Smothers Wealth Management is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by R.D. Smothers Wealth Management.